Have you ever wondered how and where companies record their assets, liabilities, and other parts of their business? Majoring in accounting, I have learned that a company's assets, liabilities, and stockholders' equity all appear on different reports or financial statements. The four financial statements are the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows, and are normally prepared in that order. The financial statements can be prepared whenever, but are usually prepared monthly, quarterly, being every 3 months, or annually, being at the end of each year. First is the income statement, which shows revenues minus expenses to determine net income or net loss. Revenues are increases in assets or settlements of liabilities arising from ongoing operations, and expenses are the decreases in assets or increases in liabilities from ongoing operations incurred to generate revenues during the current period. To prepare the income statement, the top banner shows who, being the name of the business, what, being the name of the statement, so income statement, and when, being the accounting period. First, you list the revenues, being sales revenues or any other type of revenue, if there are any. And then next, you list the expenses, such as your supplies expenses, wages expenses, utilities, insurance, or any other type. Then you subtract total revenue and total expenses to calculate net income or net loss. It would be a net loss if total expenses was greater than total revenue. After the income statement, you prepare the statement of retained earnings, which reports the way that net income and distribution of dividends affected the financial position of the company during the accounting period. To prepare a statement of retained earnings, the top banner should be the same as the income statement. Now only it would say statement of retained earnings instead of income statement. So first, on the statement of retained earnings, you list the retained earnings from last period's statement of retained earnings. And you add net income found on the income statement, subtract dividends, which are distributions to stockholders in the current period, to equal ending retained earnings for this period. Now you prepare the balance sheet, which reports the amount of assets, liabilities, and stockholders' equity of the accounting entity at that point in time. To prepare a balance sheet, the banner will be the same as the income statement and the statement of retained earnings, except now it would say balance sheet instead of retained earnings. First, you list the assets, starting with cash, being the amount of cash on hand or in the business's bank account. And then you put accounts receivable, which is the right to collect from customers on prior credit sales. And then the supplies, cost of supplies on hand, and then the cost of equipment. Add all of that to get your total assets. Now list all of your liabilities, which are creditors' claims on the company's resources. Being accounts payable, the amount owed to suppliers for prior credit purchases on account, and notes payable, which is the amount of a loan owed to the bank for a promissory note. You will add accounts payable and notes payable to get total liabilities, which is the total claims on resources by creditors. Next, list stockholders' equity. First is contributed capital, which is the amount stockholders contributed for a company's stock. And then you add retained earnings, the ending retained earnings from the statement of retained earnings to get the stockholders' equity. And then you add the total liabilities and the total stockholders' equity. And then you will prepare the statement of cash flows to report the inflow and outflow of cash during the accounting period. The inflows and outflows of cash are separated in the categories of operating, investing, and financing. To prepare the statement of cash flows, the banner shows the name of the company that it is the statement of cash flows and which accounting period is being recorded. First is cash flows from operating activities or activities directly related to earning income. So cash received from customers and cash paid to customers or to employees and supplies. Cash inflows minus cash outflows equals cash provided by operating activities. Next is cash outflows from investing activities or activities related to sale or purchase of productive assets. So cash used to buy equipment and other investing activities to show cash from investing activities. Then cash from financing activities or activities involving investors and banks. So your contributed capital by stockholders and your cash dividends paid to stockholders and cash borrowed from the bank. So the cash inflows minus the cash outflows gives us cash provided by financing activities. Now you find the change in cash, which is the sum of all three of the categories. So you take the operating activities minus the investing activities plus financing activities, and that will get your change in cash. And then you find the beginning cash at the beginning of the accounting period and the ending cash at the end of the accounting period, which is also the cash balance reported on the balance sheet. So remember, the financial statements need to be prepared in the specific order of income statement, statement of retained earnings, balance sheet, and statement of cash flow.